welcome to the PPW podcast. As always, bringing you news, views, and interviews from the world of real estate online marketplaces and prop tech industries. It's just the two of us today. Simon, how are you doing for
I'm
this
doing
week's
great,
weekly
Harvey.
news roundup?
Yeah, so what we've decided that we would have a crack at is probably release every Friday a 20, 30-minute sort of podcast where we talk about the news and what's been happening over the week and what people have released. And we'll have a chat about the results or the news and share our views.
Absolutely, and it's timely this week's one because we're right deep in financial season, right? So we've got a lot of listed companies sharing their Q1 and full year results, and we thought it would be worth and maybe a bit of fun to just have a look at what numbers they've been reporting, who's growing, who's not growing, and any points that we can take away from them. So I guess I'll go straight into the biggest one, Simon, which is Square Yards in India. 51% increase year on year revenues for a company that wants to float in the next couple of years. Good results?
Well, Square Yards is a transaction type business, right? So they have a large sales team where they help do real estate. Think of it as a digitized real estate agent that heavily relies on technology. If your objective is to list your business in a few years, delivering good 50% year on year revenue growth is an excellent result. And what that's really showing is that it's probably a combination of a couple of things. One is, just increased number of volume of sales that they're doing. And my guess is there's probably a good uptick in both the commission that they've been able to capture in that, either negotiate with new developments, and also maybe an increase in the price of those new developments. I mean, the maths around these businesses is very simple. For anyone out there, it's number of sales times the average value of the property sold times the commission that you can negotiate. Okay, that's all it is. And if you can continue to improve the commission and the average sale price, then you're going to have a good uptick. And honestly, well done to Nuj and the team there at Square Yards.
We'll try and get them on a podcast soon, hey?
Yes, we will.
A couple of other interesting ones. We've got rent.com.au in Australia. They are the owners of the very popular and what looks like increasingly successful RentPay product. I think we've got Greg Bader coming up on the podcast soon, so we can get a little bit more into that. But again, it just goes to show if you've got a really great product that people love, it's going to have a big impact on your bottom line, Simon.
Yes. Now, taken to consideration, it is a small business. Okay, we're not talking realestate.com.au and hundreds of millions of revenue here. We're talking a much smaller business, but they've done a very good job. They've done a good job at growing their business. I think transforming their model, and a 35-40% year on year revenue increase is an excellent result. Can they continue to deliver that? I'm not sure, but I think what we'll do is let's have a chat with management there in the coming weeks, and we'll find out. And so tune in for that podcast, and we'll be able to share some more information on how they're doing. I see
Yeah,
here you've
absolutely.
also got Xi'an, which is the market leader in Russia, with a 40% year on year growth as well. And I think what that's showing is that in these markets that are still developing, if you're a strong player, you can deliver good returns in that market, and that's probably a combination of some pricing power, being market leaders in the Moscow and St. Petersburg type regions, and also their expansion to other markets. So well done to the team there. I thought the interesting one on this list was Hemnet.
Yes, just outside the podium positions, they were the fourth biggest grower in terms of year-on-year revenue increases, 33.3%, Simon.
Okay. Now, what I think that is as a good indication. I think we had a conversation in a podcast a few weeks ago around they're very much doing what realestate.com.au does in the Australian market, which is go after vendor paid advertising. Very hard to do unless there is a culture of doing that in the market. But so my guess is that a lot of that revenue growth is driven by just getting more and more vendors to own their property, to pay for the advertising, and thus you can probably dramatically increase revenues, and a third increase in revenues in a year is an excellent result.
And speaking of vendor paid markets, the final set of financials that we're probably going to do for this quarter is REA Group. They have just come out with their results today, and I can reveal that it is 20% up year on year revenue to just over $1 billion. So consistent, strong performance from the market leader in Australia, Simon.
Yeah, well, it's very much built on a strong platform years ago. No, but I think we need to get behind those numbers because we've got the REA Group is not just the Australian market. You've got
True.
the Australian market. You've got Realtor.com in the
In the
US.
US.
Plus, you've got REA India and their performance. And we're talking with Drew. I think next week actually we're going to do a
Next week, indeed.
podcast with the CEO of Real Estate India. So that'll be interesting. Let's get behind those numbers. But if you're delivering a 20% year-on-year growth, you're doing very well. I'm having a look on my chart here for the financial year ended December 23, so about 4 months ago. And the large players, the Right Moves, the Scout 24s, CoStar, they're all growing at that 10 to 15% per annum type level. And so if you're delivering above that, you're doing an absolutely excellent job as a large player in that market. I think the some of the other numbers that you have on your list here, which are quite interesting, is you have Frontier Digital Ventures at
We do at
10%.
10% knob on.
Yeah, now that to me is probably a little disappointing, and I think that because you have to understand that they are operating in these early stage markets. The best part of their operations are in Latin America with their what's called LATAM 360.
LATAM 360.
Or was it 360 LATAM? It's one of those two. I get confused.
Me
I think
too.
it's 360 LATAM, run by Ricardo Frashu, who's doing an excellent job there in growing those businesses. And I would have thought overall that they would be achieving a bit of a faster growth rate than the 10% you have here. Overall, it'll be interesting to see how they go. I know they've had some very strong growth in their share price recently. And clearly the market is expecting some good performance there. A couple of other ones you have in your list, I think CoStar at 12.5% growth. What do you expect from a very large business that's doing sort of in US dollars 2.5 billion, sorry,
Two and a half
in
billion.
revenues. And
And their rival Zillow is on 13, so sort of neck and neck over there in terms of growth.
yes, so once again, I think with Zillow having stabilized the business, moved away from the iBuyer model, sort of, had a bit of a reset in what they're doing. Good growth. The real challenge for Zillow, though, at the end of the day, is can you get to a good EBITDA margin? Can you become fundamentally profitable? And when you look at the EBITDA margins of some of the other players out there, you're looking at clearly someone like a Right Move sitting at a 72%, which everyone holds that up as a beacon of what you can get. And then people forget about the Baltic Classifieds Group, which is operating at a 76%
Very strong.
EBITDA margin. And that's a 1.5 billion US market cap business, and one that probably doesn't get enough airtime and enough insights. And Harvey, we should really chat to the guys there and get them on a future podcast because that's a really good business. that's been built over probably the last decade or so. But then you get some other sort of EBITDA margins of businesses like InfoEdge, which runs 99 Acres in India, is doing a 15% EBITDA margin. CoStar's a 15% EBITDA margin. Hemnet's at a 50% EBITDA margin. Scout 24, 50% EBITDA margin. Then you have Zillow at like 5%. And that to me is the age-old problem, is that you can have a massive growth in revenues and you can have a very, very strong business. But at the end of the day, if you cannot convert that into EBITDA and a strong EBITDA margin, then it becomes problematic. And that's sort of the challenge that Zillow has faced for quite a while, is it's promised a lot in what it could potentially do. It just hasn't really delivered at that EBITDA level.
Speaking of Zillow, they obviously exited the iBuyer market, right? But there is one big remaining iBuyer in the US. Their name is Opendoor, and they are not going so well, Simon. 62% decrease in revenues year on year, and it was wide net losses as well, from what I remember. Can it survive?
Um, well, it's currently sitting at a 1.5 billion market cap, right? So more or less. And so the market's clearly expecting, not great results. And if you look quarter by quarter compared to the previous corresponding
Mm-hmm.
quarter, that minus 50%, minus 60% has been a common theme over the last year or so. The challenge they've got is that they're eking out a very small EBITDA. I mean, I think it's like 0.1% EBITDA margin based on the last numbers I've seen.
Mm-hmm.
Man, that's a lot of work for not much return. I mean, you're if you think about it, you're generating around seven. If I got my numbers here right, roughly around 6.5 billion in revenues to make 9 million in EBITDA. Not
It's a scary proposition, isn't it? And it's very high risk.
It's super high risk, and it's honestly, it just doesn't make sense, right? And as a shareholder, you got to scratch your head and wonder, can these models that are transaction but with a lot of people involved, high commission, so they can't really capture a lot of the revenue. Can they really deliver results? And I'm actually looking here at there's sort of a table that I keep sort of updates to keep a feel of what's happening. And I look at EXP Realty, Opendoor, Compass, Redfin, OfferPad. So all those US ones. Okay, and I look at them, and they're all trading at 0.2 times revenue, maybe up to maybe Redfin seems to be about 0.7 times revenue, and they had an increase in revenue, so that's good, of about 5% over the last year. But a lot of them are either break even or losing money. Now, the exception to the rule is Baike and Japan, which is
China Baker.
sorry. Did
Is
I
that
say Japan? I mean China.
yeah,
Yeah, yeah,
KE Holdings is China. Yeah.
KE Holdings or Baker. Anyway, they got like a all these American ones are trading like a 1.5 billion market cap, but Baker is 20 billion market cap. Yeah, yes, it's got 74 billion in revenues, so it swamps everything else out there. And to give you an idea, it's 74 billion in revenues compared to CoStar at 2.5. Okay.
I mean, it's madness. I mean, I know that Ed is fascinated by KE Holdings and Baker. He says this is the most interesting portal in the world, and no one's talking about them.
Well, it's because it's not really a portal, right? It's a digitized real estate transaction business that
True, they have
leverages
lots of segments.
technology.
Yeah.
Okay, so and but unlike all the other guys who are breaking even, it's making 6.5 billion in EBITDA and has a just under 10% EBITDA margin. So what it's showing is that if you can execute well at scale, and now the question is it the salaries are less? Is it because it's commission only? Is there some underlying structural difference that allows them to do a very similar model to what everyone else is doing, but operate profitably?
Yeah, I mean
And I think,
the thing about KE Holdings is that if I'm correct in that they have quite a few business segments where they have a growing renovations business, for example. So they're drawing a lot of profit out of adjacent revenue streams as opposed to just from the transaction or whatever it may be.
yeah. So I think this whole category, excluding biker, is um, incredibly challenging. And I actually had here that the average revenue multiple is like 0.3 times revenue, which is hard, and basically the average EBITDA margin is break even across that segment. And so I think the jury is out on those sort of businesses, the Redfins, the Opendoors, anything that's a transaction business at scale in I'll put a qualifier here, in an established market where there is a well-run industry, there are technologically proficient competitors, etc. I think if you look at those sort of businesses in the emerging markets or the markets that are less well structured, and maybe China is an example of that, but I certainly know from like the GUI IQI operating in Southeast Asia, etc., then you can, I think, um, grow a very interesting and profitable business in those markets.
How much context do we need to add in terms of how weak the American market is at the moment? Is this something that once things start picking up, these businesses are going to immediately uptick and everything's going to be sunshine and rainbows, or is the business going to continue to struggle even in a stronger economy?
Well, first of all, I don't think the American economy is in a bad way. It's certainly very vibrant. There's if you look in some parts, there's some strong property prices occurring throughout the US. I think that the bigger question is, does the business model actually work? And I think that's the one that probably needs a bit more exploration. And we've got enough data now over an extended period of time to say that it's not clear cut. That you can operate a big you look at something like Compass. You're sitting there at basically 5 billion in revenue, and you can't make any money out of it. You're losing 200 million. You got to scratch your head a little bit and go, well, wait a second, why can't you make money out of that? And there's got to be a structural reason. Is it an overinvestment in technology? Is it you're paying people too high a commission because you need to retain them? There might be a simple equation around that, or is there some other reason? Because I'm looking at going, well, there's 5 billion revenue, so that's yes, the revenue has shrunk year on year, but so has most of the costs, right? Because the costs are
Yeah.
variable in nature because they're commission based. So there's got to be something inherently wrong with it. And the other thing I've got to understand more about is in the whole Opendoor model is, if your revenue's off 60 odd percent year on year, it's probably a conscious decision to buy and sell less. Okay, because your underlying model, um, you're only making 9 million, which means you've probably refined your operations. You've cut employees around the place to actually allow the model to at least get to profitability or break even in there. So Don't know. In fact, why don't we put that on the list of things to explore a bit more in the future?
I was going to
Is
say the exact same thing. It sounds like a topic that it would be nice for everyone to understand it just a little bit more, you know?
Yes. So anyway, I think that's a good, quick, 20-minute odd wrap up of some of the results season that's out there. Fantastic if you are, square yards. Great result. Hemnet, fantastic. I mean, that's a very interesting business and one I think needs to be looked at even more closely. Um, well done to the big guys keep getting bigger, the KE Holdings, etc., with their strong 20% year on year growth. And, we keep an eye on the smaller guys, not the smaller guys, the guys going backwards.
Yeah,
The Open
indeed.
Doors, the Compasses and so on the world, and sort of keep an eye on, what's happening there.
Absolutely. Right. Thanks very much for your time, Simon. And looking forward to next week's news roundup. Hopefully, there's some
Yeah,
nice big stories to get into.
I'm sure there will be.
Cool.
Thanks, Harvey.
Thanks, Simon. Bye.